Ladies and gentlemen, welcome to Market Outlook, an Altec Group podcast. My name is Geraldo Ferreira, and I am Altec CEO for Americas, and I'll be your host for today. On this episode, we'll discuss about the global economic outlook revised by OECD, commodities trend, an update on graphite, electrode, and steel markets. OECD released a new forecast for global GDP growth in 2023, which is projected to be 2.7%, the lowest annual rate since the global financial crisis, except for 2020 pandemic period. A modest improvement to 2.9% is foreseen for 2024. Annual OECD GDP growth is projected to be below trend in both 23 and 24, although it gradually pick up through 24 as inflation moderates and real income strengthen. OECD highlighted some countries and regions such as India, where OECD predicts a growth of 6% on fiscal year 23-24, which will be limited by the weak global demand and the effect of the monetary policy tightening to manage inflationary pressures. And for fiscal year 24-25, they predict a growth of 7% due to moderate inflation and monetary policy easing in the second half of 24. For the United States, the real GDP is projected to grow by 1.6% in 23 and 1% in 24. Growth in private consumption and investment is expected to moderate in response to the tightening monetary and financial conditions, and as savings are further depleted. As demand is low, employment is expected to fall, and the unemployment rate is projected to gradually rise towards 4.5% in 24. With labor market tightness abating, wage growth is expected to moderate further, along with inflationary pressures. Nonetheless, the economic outlook could worsen if rising interest rates expose further financial fragilities. On the upside, faster than anticipated disinflation could allow an early easing of monetary policy that supports economic growth. The Eurozone GDP growth is projected to slow to 0.9% in 23 and then gradually strengthen to 1.5% in 24. Private consumption will be supported by strong labor markets, but higher costs of financing and uncertainty will weigh on private investment. The tight labor market will continue to fuel wage growth in 23 before wage start gradually easing in 24. Lower energy and food price will help reduce headline inflation in 23. Risk remain tilted to the downside as another spike in energy price could ignite the energy crisis, and restrictive monetary policy could expose existing financial sector vulnerabilities. In China, the economic growth will rebound to 5.4% in 23 and 5.1% in 24. Lifting zero COVID restriction has released pent-up demand for in-person service, increasing revenues in service industries hard hit by lockdowns such as tourism or entertainment. Easing of housing-related prudential regulations and lower mortgage costs have stabilized property sales. Carryover of sizable infrastructure projects from the previous year will fuel a construction boom. For Turkey, the economic growth is projected to moderate to 3.6% in 23 due to weaker exports, while domestic demand will remain the main driver of growth. The devastating earthquake at the beginning of this year brought widespread damage in southern Turkey. However, the boost from reconstruction is expected to largely offset the negative impact from disruption to economic activity. The unemployment rate is expected to stay close to 10%. Easy financial conditions will help keep inflation above 40% in 23 and 24, and nominal wage will also grow rapidly. And the real GDP is projected to grow by 1.3% in 23 and 1.1% in 24, mainly driven by domestic demand. Government support to help households cope with the energy price shock and increase defense spending will boost consumption and investment. The labor market will remain tight, with the unemployment rate edging down to 2.4% in 24. Given limited fiscal space and the need to foster lower energy use, energy subsidies should become more targeted, with a view to eventually phase them out. Additional structural spending and revenue measures are needed, especially given the fiscal pressures from an aging population. For Brazil, the economic activity is slowing due to weaker private consumption and exports. Real GDP is projected to grow by 1.7% in 23 and 1.2% in 24. Lower employment growth, still high inflation, and tighter credit conditions will limit household spending capacity despite higher social transfers. Private investment will continue to rise, but at a slower pace. Exports will be affected by lower commodity price and subdued global demand. Inflation has declined markedly over 22, but will remain above the target band during 23. Monetary policy is expected to remain restrictive, with the policy rate staying at 13.75% until at least the third quarter of 23, after which room for monetary easing may emerge. Fiscal policy remains expansionary for now, but gradual consolidation should start in 24. And the final country on our highlight is Mexico, where the real GDP growth is projected to reach 2.6% in 23 and edge down to 2.1% in 24. Consumption will be supported by the improvement in the labor market, but it will be dampened by high inflation. Investment will benefit from the easing of bottlenecks in the global value chains and the reallocation of manufacturing activity to Mexico. Export growth will be held back by the United States economic slowdown. Inflation will decline to 5.9% in 23 and 3.7% in 24. For the commodity session of our market outlook, we start with the Brent crude price. Russia Energy Ministry said the country will cut oil exports by 2.1 million tons in the third quarter, in line with planned voluntary export cuts of 500,000 barrels per day in August. Meanwhile, official data showed that U.S. crude inventories declined by more than 700,000 barrels last week, compared with market expectation for a larger 2.4 million barrel drop. For iron ore prices, 63.5% of iron content. The cargoes for delivery in Tianjin were above 116 per ton, hovering close to the 3-month high of 117 touched on July 17 as market continued to weigh on Chinese resource demand and the likelihood of government stimulus amid the country's deterioration economy outlook. Surveyors state that China's hot metal production averaged 2.5 million tons per day in late June, the highest since October 2020, suggesting that steel mills in the world top iron ore consumers are returning to full capacity. Similarly, trade data showed that the country's iron ore imports jumped by 7.4% annually in June, offsetting the sharp contraction in goods demand in other sectors of the Chinese economy. Steam coal prices were traded near two-year low of $130 per ton, driven by concern of oversupply from India and Indonesia, despite rising demand from India. Some mines in Inner Mongolia might resume operations after being shut down since March for safety improvement measures, potentially providing a further boost to coal production in the coming months. China's peak summer power demand typically starts in late June and lasts for 2 months. With the heat wave going and energy requirements remaining high, Coal consumption for electricity generation is anticipated to remain robust during the summer months. LME steel scrap. Demand in Turkey scrap market remains close to zero as steel trading becomes more challenging in Turkey's domestic market following the hikes in VAT and excise duty on petrol, which have exacerbated ongoing issues. On the other hand, the lira depreciated sharply overnight into Tuesday to almost 27 liras for $1. Turkish mills struggling to sell steel in both domestic and export markets have no appetite to buy scrap. The nickel future price impacted by weakening demand and increasing output. China, one of the biggest producers, could further restrict exports of the strategic minerals, limiting the electric vehicle production and thus hurting nickel demand. Meanwhile, the International Nickel Study Group said the market faced the largest demand-supply surplus in at least a decade, mainly due to higher output from Indonesia and Philippines. Indonesia output has already grown to 1.58 million tons in the previous year, accounting for nearly half of the world's stocks. The aluminum price fell below $2,175 per ton, approached the lowest level since September 22, as an evidence of strong supply with increasing concerns of low demand. Output out of key regions in China, the world top producer, is set to rebound as the recovery of hydropower eased power curbs for essential smelters in the Yunnan region. Market players estimate activity in the region should return to 50% of curtailed capacity by August, supporting a significant inventory buildup as higher supply overlapped with macroeconomic headwinds in China that pressure demand. Copper price. Copper output in top producer Chile sank 14% annually in May, among the latest signs that declines in global supply foreshadow an incoming shortfall amid the metal's essential use in the world's transition to sustainable energy source. The data raised concern that production in Chile may fall by more than Codelco's forecast of 7%, extending the plunge from 2022. In the meantime, a slower than expected GDP growth in China extended demand concerns from the world's top consumer, adding to investor bets on incoming stimulus from the country government. Zinc futures were trading below $2,400 a ton, which is not far from the 2 years and a half low of $2,300 reached by May 30th, amid an increase in smelter supply and weak demand. Meanwhile, China demand is recovering at a slower pace than initially anticipated, with the latest reports indicating higher than anticipated factory gate deflation, declining imports, and reduced property investment. Despite these factors, China producers are increasing their production after absorbing surplus concentrates. For ferrosilicon manganese price, we see a weak demand, limited trades, and insufficient cost support for silicon manganese, and a cautious market kept price on the lower side. Silicon manganese price remained range-bound last week due to lower than average local demand. About the World Shipping Index, we use the Freightos Baltic Index and Global Container Index as a reference. Projections for July volumes are the same level of 2019 levels. The price discrepancy could also be a function of capacity increase caused by new vessels now entering the market. Carriers increased the number of blanket sailing for Asia, Europe lanes this week, and are making some scheduled port calls contingent on volumes at those ports, as they contend with low demand and excess capacity. U.S. ocean import volumes are still way down from last year. They were above 2019 levels in June, leading some experts to describe the current market as normalizing, not collapsing. On global steel, the World Steel Association released the data of 2022 EAF production, The world EAF production dropped more than 32 million tons in 2022 versus 2021. The main drivers for this drop were China, drop of almost 30 million tons, European Union, 7 million tons drop, Russia, almost 6 million, United States, almost 4 millions, and Turkey, almost 4 millions as well. Another interest data released by the World Steel was the top 20 largest steel producer, where out of these 20, 11 are Chinese, 2 are South Koreans, 2 Japanese, 2 Indians, 1 United States, 1 Luxembourg, and 1 in Iran. The graphite electrode outlook. In July, the needle coke price rebounded, but the price are dropping year to date more than 20% on oil-based needle coke and 25% on coal-based. Those are Chinese prices. Graphite and needle coke price decreased over the year, but still above the price level of the last 12 cycle, end of 2020. In the long term, we expect the demand for electrodes and needle coke would be robust and growing on account of the increasing crude steel production through EAF instead of the BOFs. So as a conclusion, metals and scrap markets show a decrease in the pricing due to weaker demand outlook. Global freight rates are normalizing at the lower levels. Graphite electrode needle coke price decreased over the year, but still above the price level of the last 12 cycle. Annual OECD GDP growth is projected to be below trend in both 2023 and 24, although it gradually pick up through 24 as inflation moderates and real income strengthen. A slower than expected GDP growth in China is affect mainly the recovery in metal markets. Just as a reminder, our tech has participated in several conferences already this year. Just a few highlights: ASTEC 2023 in Detroit, Michigan, Made in Steel in Italy, and MENA Steel Forum in Egypt, Global Energy Show in Calgary, Canada, and our participation as well on MedTech 2023. Stay tuned to our podcast and our social media to learn about more AI, artificial intelligence, and big data analytics, BDA, and what we can do to help you in the process to be more profitable, to be more efficient. Thank you for your audience today, and stay tuned with our next podcast. Thank you. Have a great day.